Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. So, good morning, good afternoon, good evening, and welcome to LiveSquawk's preview show. Just to let you know, for those who don't know who we are, LiveSquawk is a premium audio news service for professional market participants seeking an edge. We're live 24 hours a day, Sunday to Friday. So we cover the Asia start of play and we finish on a Friday at the end of the US session. Check us out on the website, livesquawk.com, and sample what we do. If you've never tried us before, again, we do a week-long free trial for those who want to see if it will help their trading day. Anyone new to the stream, this is a half-hour presentation and we'll give you a quick overview of the upcoming data. In this instance, the US data dump that we have today ahead of tomorrow's Thanksgiving holidays in the US. And really, it's just to provide some forecasts, some bank opinion, and guest views on what to expect. Just quickly cover the boring bit here. The content provided on this channel is for informational and educational purposes only. None of the information shared should be considered as financial investment or trading advice. Now to the good bit, and I'm joined today by two guests, one, Jeffrey Hirsch of Stock Traders Almanac and Joseph Choi of Curve Advisor. Jeff dedicates his time and knowledge to arming traders and investors with the information and insight to make more profitable trades and investments at the stocktradersalmanac.com. You can learn how the stock market's historically proven cyclical and seasonal tendencies can be applied to today's markets to make you a more successful investor. So that's Jeff. And regular contributor to the show, Joe, trades as well as writes a well-regarded blog called The Curve Advisor, and we'll push the links to both of their sites out there for you to take a look at yourselves. So that's the introductions over with. Again, today's topic and preview show really relates to the US data dump we have that starts in just over an hour's time, which will be 8:30 Eastern time, 1:30 London time or GMT, and we'll have the second look at US GDP. Now, again, we wouldn't normally cover this, but I think it's important to take a look at the bigger breakdown. For those unfamiliar, you'll get the, I think they call it the prelim, and then the advance, and then the final. And in that sense, what you do is you get a first look from the prelim, which we've already had out, which showed a 2.8% growth rate quarter on quarter, quite a decent growth rate. We're expecting that to be seen in this second look. So we're looking for that to be replicated, 2.8%. Some are looking for maybe a little bit stronger than that. We'll also get initial jobless claims data on the wires at half past the hour, as well as durable goods. But I think really we're looking, initial jobless claims, I think matters because we have a jobs report next week. But in terms of what we're looking at in the near term and performance out of the US economy with a new administration coming in the new year, it's quite important to see what the breakdown looks like and how sustainable the current growth is for the world's largest economy. We'll also have, as I said, the durable goods data and initial jobless claims. But we'll also then later on at 10 o'clock Eastern time, 1500 GMT, we'll see October personal income, personal spend data. And we'll also have, obviously, the Fed's favored measure and the market's now favored measure, US October core PCE price index. Just to give you some forecasts here, I'll try and drag up the latest ones there. So as I said, GDP, we're looking for that 2.8% first look to be confirmed. If I go through some of the other bits and pieces, just the half one stuff, so you've got a clue as to what to expect. And typical as ever, it's now just been taken off my screen. Yes, here we go. So we have that 2.8%, as I said. Personal consumption, this is the quarterly read, seen at 3.7%. GDP price index, headline seen at 1.8, with the core price index on the quarter seen at 2.2%. Durable goods orders, October prelim, seen up 0.5% after the slump of 0.7% seen last month. Ex-transport, looking for a rise of 0.1% versus 0.5%. A couple of goods orders, non-defense ex-air seen at 0.1 versus 0.7, and goods shipment, non-defense ex-air seen at 0.1 from minus 0.1%. As for initial jobless claims, we're looking for that to rise a couple of thousand to 215,000 from 213,000 last week. With continuing claims seen at 1.892 million, slipping from 1.908 million. So that's the data out at, as I said, 8:30 Eastern time. If we take a look now and we go back and look at this GDP, just to give you a quick look at some of the bank research and what we're looking for. This is a note from Barclays, Jonathan Miller. He posited that the coming weeks' US data flow was poised to reinforce the narrative of resilient activity and firmed inflation. We expect the second estimate to show a 3.1% quarter-over-quarter seasonally adjusted increase in GDP for Q3, somewhat faster than the 2.8% advance estimate, reflecting upward revisions to consumer service spending and non-residential fixed investment after folding in the advance Q3 estimates from the quarterly services survey. We think that the PCE estimate will remain at 3.7%, with the upward revisions to consumer service spending roughly offset by downward revisions to prior estimates of spending in the retail sales group. So that's the US GDP data, and we'll take a look at the core PCE first. But just wanted to get just some again, opinion of the state of the US economy from an activity perspective from our guest today, and how that relates to what they look at in the market. So we'll start with Jeff. Jeff, from a trading perspective, would you be are you too concerned, or would you look particularly at today's GDP release?
I mean, we're always looking at GDP. It's definitely part of our five disciplines that we track. Mm-hmm. I look at the GDP now from Atlanta Fed, which is pretty accurate. They're at 2.6. Bottom line from my perspective is the U.S. economy seems firm, resilient. Could always use a little bit more, but it's not a situation that I'm concerned about. If the number were to disappoint, yeah, that would give me pause and make me reevaluate some things. I don't expect that to happen. Here in the greater New York City area, things seem pretty robust. People are traveling, people are buying things. I know it's not representational of the entire U.S. economy, but it's a pretty big part of it, or at least representational of some of it. And I just I don't see anything on the negative side. And seasonally, from my perspective, we're right in that sweet spot of the bullish season for the market. There's a whole host of seasonal trades and seasonal indicators. Santa Claus rally coming in, which people misunderstand that my father created. And then we've got this Thanksgiving trade here. Small caps outperform. I put that up on my feed last couple of days, and I did something yesterday about big year-to-date gains. As of Thanksgiving, it's pretty bullish for the rest of the year, and sort of a gains beget gains type of mentality here. And I don't see anything really stopping the market, except for some of these recent pauses. Admittedly, my seasonal work shows some weakness in early December as tax loss selling begins to abate, and then we get that pop the second half of the month. So I think that's what we're set up with here after Thanksgiving.
So just explaining quickly that the tax, people preparing for their taxes, maybe take a bit of profit on some trades just to cover the taxes. Could you explain that?
Yeah, sure. It's not just individuals; it's institutions, which really drives the market. But so we've had a year of pretty solid gains. We're up like 25.5% S&P so far. So when the U.S. tax code, I'm assuming there's something similar in the UK and other places that you can take your losses against your gains. So if whatever losers you have in the year, you sell those and you use that loss to counteract, to balance the gains that you made this year. That's called tax loss selling. I don't know, is that explanation any good? Or
yeah, no, that's brilliant. Thank you. Just
it's a little early over here in the States.
Cool. Awesome. Thank you for that. Joe, do you have any sort of feedback on what you're seeing from the rates markets, and what's your summation of the U.S. economy right now?
Well, just to build on the GDP commentary, I think the markets have been underestimating the underlying strength of the U.S. economy for over a year now. Like even the Fed in their summary of economic projections, they've basically had the GDP at 2%, and we're actually closer to 3 than to 2. So, so I think there might be something else going on in the economy than just what the economists are thinking. So I think with the Trump win, it is possible that we could get continued strong growth, especially since he ran on a platform of stronger growth. But I guess in terms of the 830 data, I actually don't pay that much attention to GDP just because it's a bit of a lagging indicator. I also look at the Atlanta Fed GDP now, and that's also running at 2.5, which is fairly solid. But I will be keeping my eye on initial jobless claims as well as durable goods, just because it's a little more current.
Okay, makes sense.
I think that's a great point, Joe. I think the market and the Fed have been underestimating the U.S. economy. I think the whole world has. It's definitely proven resilient. And the jobless claims and durable goods, definite numbers to keep an eye on. So I just thought that was a great point. I'm not sure the Fed needs to cut, but I don't know. What do you guys think about that?
Well, we're going to get onto that very shortly because we're going to turn to now the PCE data and the 10 o'clock Eastern time report that we have, which is, again, will give a slightly more up-to-date view of that inflation picture. Obviously, we had inflation data out of the US, CPI data out of the US about a week or so ago. But in terms of what we're looking at, you got US. So again, because there's so much data out, they've stacked them in two parts. And the second part will be, as I said, the 10 o'clock personal income, personal spending data. Just to give you a consensus, we're looking at a 0.3% rise on the month over month, which would align it with previous, and a slightly softer 0.4%, I think that's year over year, from 0.5 last. Just a note here again from Barclays, Miller says that regarding personal income, personal spending, personal income was at 0.3, which would keep it aligned. Personal spending is in at 0.4 versus 0.5 last on the month over month. Miller from Barclays again, regarding personal income and spending for last month, we expect the personal income estimates to indicate a resilient, virtuous cycle despite disruptions from hurricanes and strikes, with October's nominal gains in personal income and consumer spending both rounding down to 0.3% on the month. After accounting for PC price inflation, real spending will most likely increase by 0.1% on the month in October, although revisions to prior months are likely to have a neutral effect on Q3 spending growth. The monthly pattern of revisions may imply an even stronger carryover effect for growth in Q4, which was 1.2 percentage point in the September release. So that's a note on from Barclays on that. In terms of the core PCE, the real interesting part for many, core PCE inflation should be modestly stronger again following a 0.3% increase in September with a 0.28% increase in October in our forecasted city. But strength should largely be concentrated in volatile components that will not repeat, such as used car prices, airfares, and portfolio management fees. We're currently penciling in declines in these components in November. A decline in apparel prices could rebound next month, but we think normalization in these volatile components should be enough to imply a much more modest 0.16 month over month, 1.16% month over month increase in November core PC inflation. So those are some bank desk research pieces out there regarding the 10 o'clock Eastern time data. Again, Jeff, so if we this will bring us on to the Fed, and we had the minutes earlier in the week. So we'll take a quick look at what that implies as well.
I
in
think
terms of the data, like you both said, you guys are both live in North America. You're on the ground over there. You see really more. You can take a better temperature of the sort of economic activity, but neither of you see any kind of real concerns in terms of US demand.
No, but the prices are still up there, and I think this PCE number, should it be way above what estimates are, would be an issue. We've done some projections, and this 0.3 per month kind of puts the trajectory at not getting back towards 2%. And with the Fed cutting a half out of the blocks and then a quarter, I think they've got a little room in the chamber. I'm not sure why they feel they have to cut other than to save face, because they said they were going to. The prices are a concern. That's one of the things I do hear out there. I'm a foodie. I'm kind of a chef, so I shop for food. I know this is the core that we're mentioning here, but a lot of people spend a lot of their money on food, and I see some of the prices up there. The big discussion with eggs. It's back up. I mean, it's not crazy, but it's double what it was a year or so ago. Instead of $2 a dozen, it's like $4 a dozen. So,
and people feel that, don't they? They food. Everyone needs it. Everyone buys it on a regular basis. If you're gonna see worries appear or inflation expectations start to rise again, it's in the food, isn't it?
Yeah, but on the flip side, however, is energy. I'm seeing gas prices down. I think that's part of the Trump trade that people haven't spoken about as much. I mean, we all know he's drill, baby, drill, and the potential to, increase supply will bring down, prices. So I think there's a little counteraction there. But the PC is definitely the issue, because people see that every day when they buy their food for their families. But also at the pump, it's come down. It's still, I guess around $3, depending, a little bit higher here in the New York area. But that's come down quite a bit. So I think that maybe counteracts it. I think the Fed's done a decent job here, after their transitory inflation faux pas, and I think they could pause. I'm not sure why we need to continue to lower rates as labor. It looks like it's tightening up a little bit, and some of the Trump policies might impact that. I'm not convinced they will, but PCE is something to watch. And now I track all three of the main inflation indicators: the CPI, the PPI, and the PCE. I look at the full one, not just the core, because I think it matters. But the CPI and PPI ticked up last reading. So, I know we're expecting PCE to tick up, but it remains to be seen how much. If it's too much, I think that'll be an issue. Markets might react negatively to it.
Yeah, fair enough. Joe?
Yeah, I mean, I guess I agree in that I'm not really sure why the Fed is intent on easing. I think they got really spooked by a couple of low labor reports. But I guess the way I look at it, 2.8 year on year on core would be where the Fed thought we'd be at year end in the June SEP.
Right.
So at that time, they only thought they were going to ease once this year. So they've already eased, made 75 basis points of eases, and they're thinking about another one. So, in terms of inflation, I don't think they've made any inflation on core PCE like in 6 months. Like the core PCE has been, if anything, higher in the past 6 months than, but I guess the Fed continues to ease, and it's because they just got a little spooked by the unemployment as well as the narrative from the beige books. So I think the beige books are a lot more important to market pricing than than in the past, because they seem to rely on it quite a bit to get anecdotal information. So, the only difference, I guess, is, though, that, back in June, the Fed thought that the unemployment rate was going to be 4% at the end of the year, but it's not clear that we couldn't get there now because we're not that far off. So I wouldn't have thought that just based on data that we would be in line for 4 eases this year, but that's what it's starting to look like. With respect to the data, I guess I look mostly at core and super core, since the headline tends to be noisy with the food and the oil. I guess, so I'm looking at this data, but I'm also looking ahead. So Jeffrey Gundlach actually made an interesting point a few months back that
Sorry, this is
Q1
Jeffrey Gundlach of double.
Yeah, of Double Line.
Yeah.
So he he pointed out that Q1 inflation seasonals are probably too low, and so we've been getting higher inflation prints in Q1. So
he's been calling for a recession for a long time, Gundlach.
Oh yeah, well, except I was only highlighting this one point he made about the seasonals. In terms of his other calls, I'm not. I just wanted to attribute that. But if you look back, especially the print for January, the last few years it's been 0.5, 0.5, 0.5. So basically we've just had this long streak of like early Q1 high prints. And so I guess as a trader, I'm looking at this data, but I'm also looking, ahead a few data points. And it's not clear to me we're going to make a whole lot of progress on inflation in the next few months, especially with this core PCE expected to be 0.3. And so it'll be interesting just to see how the markets trade, because I think the markets may have sold off a little too much on the Trump election, and then I guess with the Besant pick and some other small bits of news coming out, they seem to be a little bit more comfortable that we're not going to get into an inflation spike, but the data, the way it's lining up, it looks like both the employment and the inflation data could be firmer in the months to come. So I guess that's what I'm kind of looking at right now.
Okay, cool. We'll move on to Trump very soon. Just to give you some of the comments from the Fed minutes here. Some participants said the Fed could pause easing and hold policy at restrictive level if inflation remained elevated. So it goes back to the points you guys were making. Many participants at the November meeting said uncertainty over the neutral interest rate level made it appropriate to reduce policy restraint gradually, with some participants saying that easing could be accelerated if labour market weakened or economic activity faltered. And some participants judge that downside risks to job market and economy had diminished. Others said easing could be accelerated if labour market weakened or economic activity faltered. So, I mean, reading between the lines on there, and we've heard from Powell of late, this data dependency is everything for them. They don't want to pre-commit, I don't think. I think the market's obviously got ahead of themselves at the start of the year. Again, the likes of Gundlach calling for a recession, or looking for a recession, and looking for faster rate cuts. We're not in that position, as Powell has said, and he's open to waiting, and I think he's intimated as much. And he's one of the more dovish members, if you believe all the sentiment reads. So again, I'm kind of with you guys on this one. I just think they'll take a step back in December and potentially just go with the idea that, look, there's nothing in the data that really shows any need for any major concern at the moment, and we can maybe a wait and see approach to when the new administration gets into office on January the 20th, which is when the inauguration is. Just quickly want to touch then on President Trump and just the effects as traders and as market observers, where you think this Trump trade is at the moment, and how you prepare for it going into the new year and this new government. I mean, if you look at I've got this thing from Global Data here that says financial market reaction to Trump win, Republican win in Congress. He's got a clean sweep of the House of Congress, can pretty much roll out laws that he wants. And again, Jeff, like you said, there is that flip side that if he wants to drill, that we are going to see an oversupply maybe on the energy side of things, which will bring down, everyone was talking up the inflationary pressures from a Trump administration. But if he does let the reins off for the energy suppliers, then that could counteract what we may see from external factors. What do you think, Jeff?
Well, I mean, let's remember that this is the art of the deal. Trump's the negotiator, and a lot of the stuff he throws out there is to get a reaction and or firing first shots across bows. I do think he's going to do some things with tariffs, clearly with China and perhaps our neighbors north and south. But I think that opens up the negotiation to fix some things that a lot of people were concerned about that got him in office. This is a very unique year where we have a president who lost running again. Last time it happened was Grover Cleveland. His policies, seem very business favorable with deregulation. Some of the things that he talks about are going to have to go through Congress. Yes, he's got a sweep. I can tell you that a Republican sweep is one of the better combinations for the market. You've got the best combination being a Democratic president and a Republican Congress.
Why is that? Why is that the best combo in your eyes?
My assessment is that you have a progressive executive branch trying to get things changed, and you have a more conservative fiscal body. It's all about Congress, who controls the purse strings. So you get a nice compromise. Think the Clinton Gingrich years, where you have somebody trying to get new things done, but you have a governor on the purse strings in a Republican Congress. The House is not such a great margin, and there's definitely a wing of the Republican Party that's going to make sure that really is hell bent on not spending and bringing things down. We didn't talk about the debt. We all know that countries inflate themselves out of debt. It would be nice if we did cut some spending and did bring some things down. It remains to be seen what they can really do there. But the fifth year of a Trump presidency may be more like a first year, since he learned a lot in his first year. If you look at the performance of 2017, the market was pretty strong. But he's going to be hard pressed to steamroll his agenda through the entrenched bureaucracy of DC. If the cabinet picks, are any indication, it promises to be much different than his first term. But he's still got to deal with, an entrenched bureaucracy in DC, no matter what they, clean out. But my outlook for 2025 is bullish. Not as bullish as this year. I've got an 8 to 12% gain for the market. Post-election years used to be notoriously weak, going way back. But since World War II, they've been better, and since 1985, they're the best year of the 4-year cycle. I'm a 4-year cycle guy. It's been working pretty well through most of our history, and especially the last cycle. Yeah. So anyway, I don't see much derailing the bull market, Trump or otherwise, and that sell-off after the post-election year rally is right in line with our seasonal patterns for the mid-December dip ahead of Thanksgiving as well.
Right, fair play. Just on the Trump, again, and these are threats at the moment. Trump has threatened, I think, a 25% tariff on Canada and Mexico and a 10% on China linked to fentanyl imports, or the drug on that side. And so, like you say, these are at the moment just threats, and potentially to get Mexico and Canada to the table in terms of immigration, and to try and to work a deal on that side. And with China, again, to try and to show that they're hard on the drugs side of things as well. So it'll be interesting to see if that kind of level of threat to the 25%, as I mentioned, on Canada and Mexico actually plays out, because that'll be quite hefty. And it probably wouldn't do anyone any favors. And we haven't even talked about Europe and the potential threat of tariffs on car makers as well. So, I mean, there's a lot to package, and we'll have other discussions on this, because I think this one will drag on. Joe, from your perspective, as a rates trader, and you look at rates predominantly, where do you see this Trump trade, and where do you see the prime, I guess, part of the curve that you would trade on the back of it?
Oh, well, I guess the Trump trade going in was for people just to be short fixed income. And, and I guess you can see that on the chart that you have posted. And it does make some sense, because, many of his policies could have been inflationary. You would have expected more growth. So you would have expected a lot of the eases that were priced into the curve to be taken out, and you also could have expected a higher inflation premium or term premium in the long end. I think the Bessent nomination or Bessent pick seemed to have calmed the markets down, because I guess ever since that news came out, we've basically been rallying most of the week, and I guess what I find most interesting is that after Monday, where we had the large-ish Bessent rally, Trump came out the following day imposing the tariffs, or suggesting that he would impose the tariffs. But Bessent had already said in a previous interview that the tariffs are mostly negotiation tactic. And so I think that's why the markets have just been shrugging off the tariff comments, because you may have noticed yesterday we sold off, and then we kind of rallied back most of it. Right. And then this morning we're rallying again. So, the way the rates have traded recently, I mean, we've had these large 100 basis point swings, and the swings have been fairly consistent. So I actually posted a chart on my blog a couple of weeks ago. But, but I think now that the markets are a little calmer, I think they're slightly discounting some of the Trump policies. So, if the tariffs are in fact just a negotiation ploy, or tactic, that probably needs to be taken back a little. I think the other major thing was the deporting of immigrants. But the last time I saw a quote on that, it looked like they were only rounding up the criminals that were illegal immigrants. So,
you kind of think that was his first step. It would be to start with the criminals, I guess. So, that's probably one to watch. But and potentially, I mean, if that's all he does, then there's the panic. There's less of a panic, I guess.
Right. And the other thing to keep in mind is Trump is in the hospitality business. I mean, I don't know for certain, but I would surmise that at least half his subcontractors or his subcontractors are probably using illegal immigrants at some level. And so, because whether it's, hotel staffing or landscaping or, like whatever the services are, I mean, illegal immigrants, I think, compose a large percentage of the workforce in a lot of those types of jobs. So, so it's not really clear he's going to shoot himself in the foot.
He's also got quite an ego, and he's also wants to leave a legacy of presiding over a economic prosperity in a bull market. So he's not going to do anything that's really going to jeopardize the economy of the market. And as we were both saying, a lot of this stuff is rhetoric and negotiation tactics, and maybe we live in interesting times.
Well, I think you're right. I think in terms of the rhetoric, he wants to leave a legacy. This is his last chance, his last term. He wants to be a president that was known for change and known for draining the swamp, as he said in his previous administration. So I guess he won't.
But not at the expense of the economy and the stock market.
Exactly right. So great. Listen, guys, we're going to have to wrap it up there. We are just about 40 minutes away from the start of the US data dump. I want to thank you both for your contribution. I valued it very much, and hopefully our listeners have got something out of it as well. I'll post up both your links to where people can find you, because I do think it's very much worth going and seeking you guys out, because again, the reason we have you on, we only have value guys on here, and I think you both contribute greatly to better insights into the markets and just the psyche of what we do. So thank you very much to you both. Just to quickly round off, just to go over the numbers again. So at 1:30 GMT, 13:30 GMT, 8:30 Eastern time, we'll have the second look at US real GDP expected to come in at 2.8%. We'll also see initial jobless claims, continuing claims. We'll have durable goods data on the wires. You can find all this information at livesquawk.com on our calendar. And you can listen in if you're a member, if you want to take up a free trial and hear the data released live, as I said, in the next 40 minutes. And thereafter, at 10 o'clock Eastern time, that's going to be 3 o'clock London time. We have the number, the personal income, personal spending data, and within that, the PC deflator and core deflator readings as well. So there's enough to be going on with. Maybe a bit too noisy for everyone with all this data dump at the same time. But ahead of Thanksgiving, I'd like to thank you both and wish you both a happy Thanksgiving for tomorrow. Enjoy the pumpkin pie and the turkey and the football if you're into your football.
Thanks, Harry. Thanks for having me, man. You have a great weekend.
Thank you, guys, and appreciate your help.
Okay, thank you.
Thank you.
Good to be with you, Joe.
Cheers.
Cheers.
And yes, just to wrap, as I said, please visit liveschool.com and just have a sample of have a look at what we do and see if it's something that might help your trading day. Thank you very much for listening. And we'll put this up. As I said, I'll put the links out to the guys and you can have a look at what they do and what they say for yourselves. Have a good day and happy Thanksgiving. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.